Hello, this is Economic Research Team by Will Lynch, Hassan Sheikh, Malik Himoui, and Armand Jain. Introduction. So to understand the changing nature of the New York Stock Exchange, you must consider all of the 7 following topics: digital currencies, disruptions to the stock market, long-run implications on traditional stock market access, market volatility, regulatory implications, and U.S. economy impact on stock prices. To start off, the importance of these topics. For digital currencies, it shows that there are alternatives to traditional currencies and banking methods. Disruptions of the stock market proves that the market will level out after distributions as shown in history. Long-run implications to traditional stock market shows that there are different methods to investing and they are constantly changing. Market access shows how everyday Americans can access the market. Market volatility is important for knowing how the investors react to volatility. Regulatory implications is important to understand how these help investors. The U.S. economy impact on stock prices show how important it is to know how the market will react to changes in the economy. Digital currencies. Money currency is similar to paper money. Money currency is similar to paper money, where consumers and producers can buy and sell goods. This is the beginning of a new phase in the digital age. This is a benefit to the consumers because they can access global payment systems. There are more than 9,000 different cryptocurrencies total. As more investors move towards cryptocurrencies, many have started to see the similarities to stocks. Cryptocurrency has been quite volatile. It does not have any regulations, which makes the investment way riskier. Opportunities will be more of a disruption of the stock market as regulations are on their way.
Another topic is the disruption to market practices, in which the definition is when times in which the market does not act in its normal manner and has inexplicable increases and decreases. It occurs over the spurts over the history of the American stock market. The picture on the right shows GameStop stock during and after the surge in price, which is an example of it. One of the most major market disruptions is the 1987 market crash. Prime examples of market disruptions being more random include the GameStop market disruption and the AMC Entertainment Company, which is shown to the image to the right. It proves that the strength of self-directed investors and the power of online forums to much greater than previously realized. The goal of many professional investors is to be able to beat the S&P 500. Passive strategies are trying to meet the index because it is much less risky and less fees. Therefore, passive is better and more desirable. Next, the customization of portfolios is key to meeting the needs of modern-day Americans who have different interests with their money and don't tend to follow the same trends as other Americans did before. Another topic is the market access, which is very important. It has grown heavily since the early days of the American stock market, and you have to consult a third-party broker who would then have to direct market access, which is a necessity. People still have the ability to execute trade through third-party applications, include those who own by larger firms such as Fidelity, Charles Schwab, TD, Ameritrade, and other small, independently owned applications. Market volatility today can scare off investors. It is long-term investing is one of the best wealth increasers. If you are a young investor and their first experience is a large decline in the market, it will likely end future investing from the individual, which is very unfortunate. The image on the right shows that despite market pullbacks, stocks have risen over the long term. Older investors facing retirement may exit the market because volatility could greatly diminish their savings. This could be catastrophic because they can count on it to live as they don't have regular income later in life. However, the flip side of volatility is that it has a lot of opportunity because when the market is low, investors take advantage of it and interest, which could produce desirable long-term gains.
Regulatory implications. Regulatory implications aim to protect investors, ensure market stability, and promote fair trading practices. Regulations cover areas such as listing requirements, margin trading rules, prevention of market manipulation, and inside trading. Cross-border regulations, high-frequency trading oversight, and investor education. Regulatory implications play a vital role in maintaining transparency, integrity, and confidence in the stock market. These implications ensure a healthy and safe market for all. The U.S. economy's impact on stock prices. Things such as how much the country is making, GDP, how many people are working, also affect the stock market. Interest rates also play a part, acting like the economy's heartbeat. How people view the stock market, sentiment can be just as important as well. The stock market isn't just a gauge, it mirrors all different things happening in the economy. The direction of the economy always has a huge impact on the stock market because investors believe the U.S. economy is trending up and that the stock market will follow it. The other important aspects is innovation because companies are always creating new products and ideas, and this interests investors. Creation of artificial intelligence in recent years has had a great impact on the stock market because the growth rates are much higher than the overall market. Conclusion. The changing nature of the New York Stock Exchange is a complex topic, but through the breakdown of our topics, digital currencies, disruptions to the stock market, long-run implications to the traditional stock market, market access, market volatility, regulatory implications, U.S. economy impact on stock prices, we were able to evaluate the NYSE and the overall economy more efficiently and accurately. Thank you for listening.